Thank you. I'm delighted to have this opportunity to talk a little bit about my research. And it turns out to be surprisingly stressful to be in front of you with the title of this one. So just to be clear, this is not about you. This is about the other people. And so this is a joint work with Ale Pravitero and Brian Meltzer. So they at least share a little bit of the blame of whatever I'm going to say here. So the paper is going to be about the advisors to households, and we're going to have data from Canada. And as a background, of course, both in the US and internationally, many households rely on financial advisors. If you ask the people in the US who own mutual funds, 53% of those people report having received some advice from somebody on what funds to buy. And as I mentioned, we had the data from Canada, and in Canada, 80% of all the retail assets are advised. And this stuff is kind of interesting because there have been lots of questions and concerns about the quality and cost of financial advice, not just in the US, but elsewhere. Specifically in Canada, I'm going to show you some numbers in a moment, but if you look at households in Canada who are advised, they tend to lag passive benchmarks by about 1.5 to 2.5% per year, which may not seem much, but if you think about the investing for the retirement cycle over 30 years, that compounds to something like 15 to 25% of total wealth. And then the question has been, what do people get in return for these fees or this underperformance? And to get a sense of what type of things people are asking here, there's this very cool study by Mullanas and Knott and Shore, this audit study, where they hired a bunch of actors in Boston, and they sent them to different financial advisors with a script. They gave some of these actors passive low-fee portfolios, and other people, they gave these high-fee active portfolios. And they kept track of what type of advice these people were getting. And what they found here was that advisors encourage chasing returns, push for active managed funds, and even actively push them on auditors who begin with a well-diversified low-fee portfolio. And the implication here was that this is coming from conflicts of interest, that surely these advisors don't actually believe this stuff. They only do this thing to maximize their own commissions. And that has been something that has remained the focus of both the research and also in terms of policy implications and policy recommendations. In the US and in Canada, advisors, of course, are often compensated through commissions on the products they sell. And there have been lots of policy changes and proposals about this one. In the UK and Australia, there has been a complete ban on commissions in advisory business. In the US, there's the Department of Labor's proposal of fiduciary duty on advisors. That's in limbo at the moment. So in this paper, we wanted to investigate a completely different channel that would have starkly different policy implications. The idea that we had here was that maybe advisors are not giving bad recommendations only to maximize their own commissions, but maybe they generally think that pursuing active management and chasing returns in high-cost funds is actually the welfare improving, the return improving strategy. So what do we do here? This is completely built on amazing data that we have. We got this data from back office, as I'm going to mention in just a moment, and the key feature of the data is going to be that we are not going to see only the client's portfolios and trades, but we are going to see the advisor's portfolios at the same time for incidental reasons. And just in case that you throw me out before the time is out, because I say something outrageous, let me just summarize my findings very briefly. What we find here is that clients and advisors both under-diversify, chase returns, and prefer higher cost active managed funds. And most importantly, they earn similar net returns even after fees and rebates. I'm going to come back to the rebates in just a moment. That applies to the advisors. An advisor's own behavior is a really strong predictor of how the clients are going to be behaving. So if you take an advisor who has a strong tendency for chasing returns in trading, he or she is going to be advising his or her clients to behave the same way. And very importantly, we're going to find here that advisors keep on behaving the same way even after they stop advising clients. I'm going to explain in just a moment why that's kind of important for our story. And this is not only statistically significant effect. I'm going to argue that the economic significance of this mechanism is really substantial as well. Specifically, differences in advisors' personal beliefs drive substantial variation in client performance. Okay, so the data here comes from Canada, and we had data from 2 independent Canadian mutual fund dealers. So these are not affiliated with any banks. They can and do recommend mutual funds from the full menu of options. We have more than 3,000 financial advisors and more than 500,000 of their clients. The total AUM in our data is $18.9 billion, which is about 6% of the total mutual fund dealer association assets in Canada. This comes from the back office, so the data are very reliable. We see all the holdings, transactions, and the fees that these people pay. And we also have the Know Your Client forms. So both for the clients and the advisors, we know the age, risk tolerance, investment horizon, financial knowledge, income, and things like that. So we know a lot about, not only about the clients, but also about the advisors. Now, the way the data is set up, we see people based on their Canadian social insurance numbers. They are masked, but the numbers are unique, which means that if somebody happens to be both an advisor and a client, they show in the data with the same ID. And 3/4 of the advisors in the data show up in the data as clients as well. You work for a firm, and you have your own portfolio at the same firm. So we see both. We see how you behave as an advisor, and we see what you are doing in your own portfolio. We don't see the portfolios for everybody. Most of the people we don't see the portfolios for are younger and less wealthy. When they get a bit bigger, they have their own real portfolio, and they bring it to their own firm because they get some benefits from doing so. Importantly, our ability to see advisors' portfolios is completely incidental. It doesn't mean that clients would have access to this information. Clients would know what the advisors are doing if the advisors willingly disclose this information. There's no mechanism here that would mean that you see what your advisor is doing. Advisors in Canada have to pay all the same fees as the clients. The only difference is that because they're also acting as the advisor to the trade, they get the sales commissions and they get the trading commissions on the trades. We call them as rebates over here. And when we do some performance computations, we're going to take those into account. So to set the stage here, let's look at very briefly how advisors and clients behave in our data. And we are going to quantify their behavior in 6 dimensions. The first is going to be turnover. How frequently do the clients and the advisors trade? Given that Terry gave the talk just before me, I put a citation here to Barbara and Odin. We are going to be looking at the value of purchases and sales divided by the value of holdings. We are going to look at active management. What fraction of assets of these people are invested in active managed funds? Here, the definition of passive would be life cycle or index funds. We look at return chasing. The way we quantify return chasing would be we rank every month that there's a purchase, we rank all the possible funds based on past returns over the prior year, and we see what's the percentile of the fund that you actually purchase. We look at under diversification. The way we quantify under diversification is to compare that against the MSCI World Index. That's a pretty well diversified index. If you're more volatile or deviate from that index, we call that under diversification. You could measure it in any way. You get the same results. We also look at mutual fund fees. What's the average MER of the funds that these people buy? And given that we see the full portfolios, not just equities, but also money market, fixed income alternatives, we also look at the differences in fees controlling for the asset class. So we divide funds into 5 categories: equity, balanced, fixed income, money market, and alternatives. And within each asset class, we ask how cheap or expensive are the funds that these advisors or the clients purchase. So to give you an idea of what we are doing here, here are the 6 measures of behavior that I just described. Return chasing, for example, the 60% here means that the average client buys a fund that has above average performance over the prior year. If they just randomly bought a fund, they would be buying the median fund at the 50th percentile. They are chasing returns a little bit, as has been documented before. Active management, 98.5% means that almost all the value assets of these people are invested in active managed equity fund, active managed funds. Turnover, 31%, 34% in retirement accounts and open accounts. In the rest of the discussion, I'm not going to divide the data into open and retirement accounts because in all dimensions, they look the same. Under diversification, that was about the annualized volatility of residuals, 7.3%. Canada is very expensive. In fact, it's the most expensive country in terms of mutual fund fees. And so the average fee that these people pay, just the MER, is 2.36%. If you look at the cheapness or expensiveness of mutual funds, so you control the asset class, the fund that is typically purchased is at the 43rd percentile of the distribution. So it's a bit on the cheap side. But being on the cheap side doesn't mean it's cheap. 2.36% per year is pretty substantial. So I left out here, I blanked out the behavior of the advisors themselves. If we go with the conflicts of interest explanation, we would expect to see dramatic differences between the behavior of the advisors and clients. They do something for the clients only because they want to maximize their commissions, themselves, they do the right thing, whatever that might be. In that case, the numbers would be very different. So at the first pass, that story doesn't seem to hold much water. If you look at return chasing, clients are 60th percentile, advisors a bit higher, active management higher, turnover higher, under diversification higher, total MER higher, and even if you control for asset class, if anything, the advisors are investing in a bit more expensive funds than what they recommend to their own clients. Okay. So to undersell the results here, we could be saying that there's not much of a difference between the behavior of the clients and the advisors in the data. And again, this is very different than what you would expect if conflicts of interest was driving the type of behavior that we see from the clients in the data. So the question we wanted to ask in the paper was, do advisors encourage their clients to trade like themselves? And to give you an idea what we're asking here, think about the return chasing measure. We have about 500,000 people. For every one of them, we can compute the average measure of return chasing. Some people are going to be kind of like momentum traders. They're going to be at the right tail of the distribution. Other people are going to be contrarians. They're going to be buying the funds that went down in value in the hopes that it's going to be coming back. And we want to be asking here first if the identity of the advisor is going to be explaining meaningful variation in how clients behave. If somebody's going to be in the right tail of the distribution or the left tail of the distribution. The second question is going to be that if advisor is important in explaining that variation, is it happening because the advisor encourages the client to trade the same way? The advisor chases returns, and he or she recommends the clients to do the same. So what we're going to do here is we're going to be looking at how important the identity of the advisor is explaining in variation in client behavior. So specifically, we are asking if most of the variation in client behavior is stemming from what the clients look like on paper, on the KYC forms, or if it just happens that the identity of the advisor is really important. You randomly assign different people different advisors and see how the behavior changes, if at all. And then if the identity of the advisor matters, is the channel the one that you would expect, that advisors and clients trade the same way? Now, there's a really important kind of like academic point over here about endogeneity, meaning something may not be well identified. And if you think about this for just a moment, and you have probably thought about this much more than I have, it's going to be kind of obvious that even if we find that clients and advisors behave the same way, it may not imply causation. It may just be happening because there's this endogenous matching between clients and advisors. Somebody hooks up with this advisor because they happen to think about the world and investing the same way. So it wouldn't be surprising that you find that advisors and clients, they always chase the returns the same way, they always invest in same type of funds. Not because the advisor provides input, but just because they think about these things the same way. So how can we make any progress here? We can use these displaced clients to control for any type of client level heterogeneity in behavior. So it's going to be really simple. It just means that we're going to be looking at clients who are served by multiple advisors over the sample period. That means that we can hold the identity of the client fixed, and we can just see how the behavior changes when you move from one advisor to another. Now, of course, there would be added complication here. The complication would be that maybe you get rid of your old advisor and get a new one for some endogenous reasons again. So that wouldn't be valid. So what we do here is we use forced changes in advisors. Specifically, we are looking at cases where the old advisor leaves the industry or the firm. What happens in this case is that the entire book of business of the old advisor is sold to somebody else. That book is very, very valuable. And so there's going to be very little selection in that step. It means that all the clients of the old advisor tend to go to the same new advisor. They are not making the choice to match up with the new person in some dimension. And indeed, we see this very strongly in the data. If we look at these things we call forced changes, when somebody retires, quits the industry, or dies, we find that 85% of the displaced clients remain at the same dealer, and conditional staying at the same dealer, 87% of clients go to the same advisor. So this can be very nice from academic viewpoint of identifying some kind of effect coming from the advisors, the clients. Because effectively, we are kind of close to the ideal thing where you take the population of people and you randomly assign advisors to different people. In real data, you don't see that stuff. We can get kind of close to that ideal by looking at these forced changes in advisors. Okay. So I'm going to have a bunch of numbers here, but the question here is going to be really, really simple. Every number here is going to be between 0 and 100%, and they're going to be R squares. It just means how much of the variation in behavior in some dimension we can explain by the identity of the client, him or herself, how much can we explain by taking into account just the identity of the advisor, and how important are both of them at the same time. So when you look at the first number in the table, the 5.1% for return chasing, it means that if you know the identity of the client, and this is more than just a KYC form, this is actually just exactly holding the identity of the client constant. With that thing, you can explain 5.1% of variation in return chasing behavior. That was the histogram, the distribution I just showed you before. If, on the other hand, you take into account the identity of the advisor only and pay no attention to what the client looks like, you can explain almost 20% of variation in return chasing behavior. So in this dimension, advisor is 4 times more important than the totality of what the investor looks like. If you take both of them at the same time, you explain about 1/3 of the variation in how people chase returns. The same pattern holds across all behaviors. And the only point of this slide is to tell you that advisors seem to be really important in explaining variation in how clients behave. It's not really coming from clients wanting to do something. Advisors actually encourage them to behave in a certain way. Now, the follow-up question, of course, is going to be if this encouragement follows from how advisors think about the best investment practices themselves. I put some equation here just to give it the appearance that we put in some work over here. But the idea is going to be really simple. The behavior fixed effect is just a fancy way of saying that let's look at how the average client of this advisor behaves, controlled from a bunch of other things. Okay? That's the thing that we want to explain. How does the average client behave? And on the right-hand side, we are going to have the behavior of the advisor, him or herself. Okay? A really simple thing. How does your client behave in terms of chasing returns? How does the advisor behave in terms of chasing returns? In this regression, a positive slope would mean that an advisor trades the same way as his or her clients. We have 2 sets of numbers here, but it doesn't really make any difference where you look. Whether you look at the basic model or the 2-way fixed FX model, the whole point here is that no matter how you look at this thing, you just see these positive numbers across the board. It means that in every dimension, advisors and the clients trade the same way. If you're an advisor who likes to chase returns, like momentum trading, then your clients are going to be doing the same because you told them to do the same. If you invest in cheap funds, you're going to be the one who has the clients who also invest in the cheap funds. Okay. So the argument so far has been that this is coming from what we call misguided beliefs. The idea that these advisors think that this is the right way to behave, they do it for themselves, and they encourage the clients to do the same thing. There would be some objections to this one. There would be some alternative explanations. One important one would be what we call the window dressing, which is a catch-all term for maybe the advisors are behaving differently than what they would only because they're advising clients. So it could be, even though advisors don't have to disclose their portfolios, maybe they actually do disclose their portfolios willingly to encourage their clients to do something. So if the advisor, him or herself, invest in expensive, active managed funds, maybe it's easier to convince the clients to do the same. You might also have some other explanations along the same lines. You might think about cognitive dissonance. If I tell my client to behave in a weird way, it may be difficult for me to behave differently in my own portfolio, to live with myself. That's a cognitive dissonance. To resolve the cognitive dissonance, I'm going to behave the same way as I advise my clients to behave. So how can we address this concern? The obvious way to do it here would be to look at the changes in advisor behavior after they leave the industry. They shed their clients, now they're on their own. If they only pretended to believe something before, now we should see their true beliefs, how they behave when they're on their own. So do advisors behave differently after they stop advising clients? The key thing here is that advisors often keep their investments at the same firm after leaving, which means that we can be tracking the same people when they're advising clients and then seeing how they behave after they stop advising clients. You wouldn't want to have complete separate populations, advisors and other people. That wouldn't be a fair comparison. You want to see the people when they're advising clients and the same people after they stop advising clients. So if you look at return chasing, for example, here we are going to have the average behavior for the advisors when they're active. In terms of return chasing, we are at the 63rd percentile when the advisors are active. We are falling a little bit to 58th percentile when we go to post-career, when these people quit the industry. If you look at active management, there's just a tiny bit of change on that. But a far cry from what you would expect if these people were investing active funds only to convince their clients to do the same. In that case, you would expect to see a dramatic change in behavior after retirement. Active management goes to 99.5% to 98.6%. Turnover actually jumps up a little bit after retirement, but this may be in part because of rebalancing after the retirement event. It goes from 35% per year to 53% per year after retirement. Under diversification falls down a little bit from 7.9 to 7.2, but again a far cry from what you would expect if people were just behaving differently when they were active to convince their clients to do the same. You do see a bit of a drop in fees. If you look at the total MER, the management expense ratios, when they were active, the average fund that they bought had a fee of 2.47%. When they retire, it goes down a little bit to 2.33. And you might be saying that, well, this is the evidence that these people were actually behaving differently. Now they know that they want to be investing in the cheap funds. But if you look at the percentile fee within asset class, that was the measure where we keep track of asset allocation. We are not treating all the funds the same, equities, money market funds, fixed income. Instead, we are keeping track of how expensive or cheap a fund is within the asset class. In that comparison, you don't see any change or even a slight increase in the expensiveness of the funds around the retirement event. You go from 45.8% before retirement to 46.2% after retirement. So this thing here, I think, is very powerful evidence of advisors not altering their behavior when they're active just to convince their clients to behave in a certain way. It really looks like advisors believe that this is the way I should be behaving. I'm just telling my clients to behave the same way. Okay. The important question here would be about the investment performance of the clients and advisors. The behavior doesn't have to tell the full story. You could look the same in all these dimensions, well, maybe except for the fees, but then your performance could still be dramatically different. So it's kind of interesting to look at, well, what's the average alpha that you generate for the clients, and what's the alpha that you generate for yourself? It would be kind of damning if there's a massive difference between the two, because that would be direct evidence that they really have these best ideas, but they keep the best ideas to themselves. So it doesn't really make much of a difference how we do the computations here. All the action is driven by the fees. But just again, to give you the appearance that we put lots of effort into this one, we are going to be computing alphas from 4-factor model. So it's going to control for the market size, value, and momentum. And then we're going to throw in 2 fixed income factors, the term spread and the default spread. But again, that doesn't make much of a difference. You can do a CAPM. You can just look at the fees themselves. It doesn't really do anything. So let's see the story the numbers are telling us. If you look at the value-weighted portfolio of all the clients in our data, the gross alpha on that portfolio is negative 69 basis points per year, statistically insignificant from 0. So it means that before fees, clients are underperforming the market a little bit, but you cannot tell their performance apart from that of the market. Now, when you layer in the fees, and the fees are really substantial, you can of course see that the performance must be falling substantially. And indeed, it falls down to about minus 3% per year for the clients. D-value of minus 3.6, meaning that we can really say that these people are lagging the market substantially. By the way, if you think that the 4-factor model, bond factors comparison is kind of unfair, that this is not what the people would do if they were left on their own, the same result also holds if you do something like comparison to a life cycle fund. Life cycle funds are kind of expensive as well, and so forth, but that would give you the same result. Now, the advisors are the ones that are interesting here. What does the performance of the advisors look like compared to that of the clients? The gross alpha, so not putting any fees for these people in, the gross alpha of the advisors is minus 125 basis points per year. It's a bit lower than that of the clients, but it's also statistically insignificantly different from 0. So again, we cannot say that advisors are underperforming the market before fees. But they have to pay the same fees as the clients, and so they're going to be underperforming the market once you take the fees in account. Over here, I say with fees and rebates, because as I mentioned before, as an advisor making the purchase for yourself, you get the same sales commissions and you get the same trailing commissions on the purchases and the holdings. So that's why the gap between the net and gross alphas is a bit smaller for the advisors than what it is for the clients. So the net alpha for the advisors is about minus 3% per year, instead of being 3.2% as it is for the clients. Still, I think it's fair to say that the net alphas that the advisors and the clients earn on their respective portfolios are kind of comparable. There's not really a meaningful difference between minus 3.2% and 3% in data. Both of them are massively underperforming the market, and they're mostly underperforming the market because of the fees that they pay. Now, the fact that the numbers are different already tells you that in some cases, advisors and clients do not behave the same way. Advisors sometimes do something that they don't tell their clients to do. And the question was, well, what do those trades look like? You can already figure out from these numbers what the answer must be. It tells you that when advisors deviate from the clients, they deviate in the wrong direction. They do something that, at least in our sample, didn't turn out to be such a good idea. So how is this going to work out? Let's see if I can find a light here. No light. Okay. So if you think about the clients and the advisors, think about taking the advisors and forcing the advisors to hold exactly the same portfolios as their recommended clients. So they're not allowed to deviate from the clients in any way. Now, then when you take the gross alpha of the clients, that would be the gross alpha that would be earned by the clients, by the advisors as well. Now we would go to the net alpha, but the difference would be that advisors would pay the fees, but they would also get the rebates, which would mean that their net alpha would be much better than what it is for the clients. And as a consequence, it would also be much better than what the advisors get for their own portfolios. Specifically, if we were to force advisors in our sample to hold the same portfolios as what they recommend to the clients, so the average portfolio they give the clients, the performance would be much, much better than what it actually is. They would lose to the market about 226 basis points per year instead of 301 basis points per year. And the difference between this hypothetical portfolio, what the advisors could be doing instead, and what they actually do is kind of substantial. 75 basis points, t-value of 3.5, meaning that there's a massive amount of room for improvement in the advisor portfolios. And I think this is kind of cool because it tells you that sometimes clients and advisors behave in different ways. But when advisors deviate from what they tell their clients to do, at least in our sample, they unfortunately deviate in doing the wrong thing. After the fact, they lose money by making these trades. So the part of the advisor portfolio that does not overlap with the client portfolio significantly underperforms the common part. By the way, I should have mentioned before, when I showed you these results on the behavior, that this commonality between the clients and advisors goes much deeper than the numbers that I showed here. What we also did is we look at the exact timing of all the purchases and sales in the data. And not surprisingly, we find that when the advisor recommends the clients to trade something, on the very same day or right around it, the advisor does the same trade in his or her own portfolio. So it's not just that they look the same on paper in these dimensions, they actually trade the same funds on the same days in the data. So there's a very strong evidence of advisors and clients behaving the same way to the level of the individual trades that these people make. So just to recap this part over here, the performance result here is that, well, advisors and clients seem to perform about the same in terms of net alphas. And in fact, when advisors deviate from the clients, they deviate in the wrong direction. They would be better off by holding the client portfolios themselves. Okay. The concern would be, I kept on talking about these t-values, t-value of 3.6 and so forth. What do these numbers mean? Does this really mean that we should care about this stuff? What's the implication of this channel to client performance? And when we do something kind of intuitive over here, we take all the advisors in our sample and we just assign those advisors into bins based on their alphas. So the guys in the bin 1 are going to be the ones that had the lowest net or gross alpha over our sample period. The advisors in bin 10 are the ones that had the highest performance in our sample. So not surprisingly, given our results, we see that if we look at now the client alphas for the same advisors, we see it trending up, which just means that if you are a client who hooked up an advisor who had good ideas during the sample period, your performance is going to be good as well, because he implements the same good ideas for himself and for the clients. If you look at the advisors who turned out to be really bad ideas during the sample period, their own performance is going to be really horrible, and so is going to be the performance of their clients. And the spread between the top and the bottom is kind of non-trivial. You remember how in the beginning I mentioned that the average fees are about 1.5 to 2.5%, and how that compounds over time to 15 or 25% over 30 years. Here, the gap between the worst and the best performing advisors the performance of the clients is 1.6%. It doesn't make a difference if we look at net or gross of fees, which means that this belief channel is economically as important as whatever is happening with the fees, as the level of the fees. Now, in terms of the big picture over here, I started by saying that individuals seem to rely quite a bit on advice. And many people acknowledge that they should be turning to financial advice. We look at some surveys, and in surveys, about 3/4 of the people say that they would benefit from some advice and answers to everyday financial questions from a professional, which kind of makes sense. I don't know how I should be making my own investments. So don't ask me about any advice. Now, even though we have lots of concerns about conflict of interest, it kind of makes sense. If you get sales commissions on the stuff, maybe you would be recommending the more expensive stuff. At the same time, our evidence here is that there's maybe much more important channel at work here, which is that advisors and clients are behaving very much the same way. So we document this broad similarity in how advisors and clients trade and also in their performance, which also means that advisors' own beliefs, as revealed here through their own trades, seems to drive substantial amount of variation in client performance and behavior. So why is this important? If you think about all these policies that are aimed at aligning client and advisor interests, like imposing fiduciary duty and so forth, they do not address this channel at all. They just think that as soon as we force these people to behave in a certain way, all these problems are going to go away and all the fees are going to go to zero pretty much. But that's not what our evidence is saying over here. It says that advisors are already doing the stuff that they think is the right thing to do. And so if we impose fiduciary duty, it wouldn't be really addressing this channel at all. By the way, I'm not advocating here one way or the other. I don't see what harm would come from imposing fiduciary duty, but at the same time, you're always concerned about unforeseen consequences of actions. So if we do that stuff, something funny might happen. So I'm not taking a stance here if it's a good idea or a bad idea. I'm just saying that imposing a fiduciary duty wouldn't be addressing the mechanism that we have here. So resolving conflicts of interest may reduce the cost of advice by less than what policymakers seem to be hoping. And the key thing here is that many advisors are already behaving the same way as their clients. If you tell them explicitly to do what you think is the best for the client, you don't expect to see much action over here. The real question here is going to be whether we should be doing something to address this problem of misguided beliefs. And the follow-up question would be, well, how can we do it? And it's not obvious what the solution would be. Is it going to be about education or screening or some kind of regulation about what kind of certificates you need to have? But that's something that we definitely have to think about. At least from the academic perspective, there's also this kind of interesting selection mechanism here at work that I think is kind of important. In Canada, you have about 80,000 financial advisors. And the view in the media has largely been that we have these 80,000 people who effectively go in this industry just to earn commissions at the expense of their clients. That's all they do, and they knowingly do that stuff. The alternate explanation here would be that maybe it's coming from selection. If you had 2 recent graduates, and one of them took Terry's investments class and has come to believe that maybe the best thing to do would be to invest in low-fee index funds. That's pretty much the best thing to do. The other person didn't take that class and comes to believe that maybe active management actually adds lots of value. Which one of these two people is more likely to end up in this industry? This person thinks that there's not much value to be added by doing this thing. This thing over here thinks that active management is a great idea. We can increase the size of the pie, and there's going to be more for me left over. So this might explain why there's going to be this bias towards active management in our sample, because you end up with those people who believe that active management adds the most value. I'm out of time here, but thanks for the comments. And if you have any more questions or comments, I would love to talk about this stuff. Thank you so much.